Okay, can you all see the slides now on your screen? Just give me a thumbs up if you are able to do so. Okay, good. So the agenda for tonight will be really covering these few items. First of all, a situation analysis where we are today. Then we'll take a look at the bull and bear arguments, and I will share with you how I'm still investing in this particular market where, frankly speaking, it's not very difficult to do the investing and continue to do the investment, even with the current very volatile situation. And um, I think you have to look at it from a long term and versus a short term, what you should do, what kind of positions you should hold, and so on and so forth. Then the other thing is, if you are quite a beginner as far as investment in the stock market is concerned, let's take a look at managing your emotions when you are investing. And then I think it is important to build a portfolio. And this is actually a very, very good time to build a portfolio. And there are quite a lot of good stocks potentially that you can actually add on to your portfolio. And finally, I'll have a summary. So some of you know me, some of you may not know me that well. So let me spend a little bit of time just talking a bit about myself. I have actually spent about 2 decades in telco and technology sector, and was doing sales, product, and also marketing. After that, after the corporate world, I actually started quite a number of companies. And the last company that I invested in was actually sold to Singtel. So I am trained in value investing and options trading. Uh, I'm just looking at my screen, so I'll be sometimes disturbed a little bit or distracted a little bit, because I think some people may be joining in and I have to admit them in. So just give me a second. Okay. So I've been trained in value investing and options trading, and I have really been quite actively investing in the stock market for over 15 years. So it's not too bad. I have been having good returns, but I make sure that I am very consistent insofar as my returns are concerned. So last year was actually quite a good year for me, where I averaged about, I actually did about 20% last year. And a lot of this actually came from the gains that I took from Apple, Alibaba, and Facebook. So right now I have actually kind of achieved financial flexibility. I still run a number of companies passively, but I would probably say about 50% of the time I do investment related activities. So I have also a portfolio of $1 million, which I am actively managing. Right? So just to share with you and to put the perspective correctly, right? If you look at how the stock market works and what is comprising of, the stock market moves up and down, and when prices come down or prices shoots up, sometimes you can find reasons, but sometimes really you look around the news, all of a sudden the share price of a company goes up or the share price of a company comes down, and you look around for news to see, hey, what explains the price movement, but you can't find any. So that's how the market moves, right? How the market reacts and how the market behaves. So sometimes don't try very hard to try to find explanation for the price movement. And as far as the stock market is concerned, there are players who are value investors. They are the long-term investors. You also have the short-term traders. They will go in looking at technical chart, and then they will have stop loss kind of measures. Yeah, and then there are, of course, the hedge funds, the pension funds, and also retail investors like you and me. So it's a very mixed bag of people and all of us, of course, is trying to make some money from the stock market. Short term, the market is generally irrational. So like I mentioned just now, sometimes you look at the price movement, you really don't know what's happening. But what is important to note is that in the longer term, the share price reflects the earnings of a company. So later on, we'll have some examples of companies and we'll analyze them and so on and so forth. You will understand that, hey, if the share price of the company were to go up in the longer term, it must be because the earnings of the company is actually going up. So longer term, uh, there's actually a proportional kind of thing between the share price as well as the earnings. And of course, as far as the market is concerned, it's two emotions at play, right? Greed and then fear. So where are we now? Actually, now it's already 23rd of May, 2020. The current financial turmoil is actually triggered by COVID-19, and it was first reported end of December 2019 in China. And as of today, 5.2 million people are infected globally with 335 deaths. And unfortunately, the world's largest economy, US, is topping the list with 1.62 million infected and 96,000 deaths. And I think this is going to go up still, right? We don't see that this is tapering off yet. We have seen global lockdowns, and recently, of course, we are seeing that China is opening up again in its economy, and then other countries are trying to ease the lockdown restrictions. And this is something that we want to take a look at, because if there is second wave and all that, it's all going to impact the market. Already we are seeing that there is some new cluster happening in Wuhan in China, and they are stepping up all the COVID-19 testing again. And right now, what we are also seeing is that in many countries, the interest rate is very low. And in some countries, the interest rate is even negative. The US Fed and other central banks, they are also rolling out massive quantitative easing. And of course, the various governments are launching a lot of fiscal policies, and especially in the States, it's actually going into the trillions of dollars. So are we looking at V-shaped recovery? I think this is a topic that we want to discuss, and then we can take a look at. So let's take a look at the US S&P 500, and I think the same can be applied to the Singapore analysis as well. But let's take a look at the S&P 500. So from the high, it has actually come down in March. It has lost a value of about 35%. And then since very recently, in a very short period of time, it has gone back up to about the 3,000 level. So a very short period of time, it has plunged 35%, and within a very short period of time, it has gone up. So now the question is it going to go up some more, or is it going to come down? So later on, I will give you my opinion, but let's take a look at both sides of the aisle. What is happening? Why is it that there is a rebound over here? And then what is going to happen? Whether the rebound is going to continue, or there are certain factors that we have to be very careful of right now. So what caused the recovery? Insofar as Congress is concerned, of course, they have launched trillions of dollars. They have given money to individuals. Then, of course, the Fed is also talking about open-ended asset purchases or quantitative easing. This is not new, but the quantum of the money is tremendous. Later on, I will show you a chart. And also in terms of the asset that they are purchasing, used to be just treasury bonds, but now they are also going into corporate bonds, and including even some junk bonds. And of course, later on, I'll explain to you why this has got some impact or immediate impact to the stock market pricing. So QE is not exactly money printing. I think some people have this misconception that QE is money printing. It has some similar effect, But in the shorter term, it's just going to ease the credit pressures, but it's not going to cause much inflation. But QE cannot last for too long. When it lasts for too long, then you have this inflation issue coming in. So stock market is indicative of future earnings. Let's remember this point. And of course, right now, what we are seeing is that a lot of companies are going bankrupt, filing for bankruptcy. Like the latest is JP Penny, and then you have Hertz. And I'm pretty sure a lot more companies, the big names, will be also filing for bankruptcy as long as this whole crisis is not resolved, right? And whether this crisis is going to be resolved shorter term or not, let's also investigate and take a look at what are the various factors. So analysts, some analysts are optimistic about economy reopening, right? So that also caused a V-shaped recovery to a certain extent recently. And of course, there is also some hope of antiviral drugs and vaccine. And of course, there's probably also the FOMO at play, fear of missing out. So let's take a look at the Fed balance sheet. If you go all the way back to the last financial crisis, in terms of the quantitative easing, we are talking about 2 trillion. For this particular crisis is 6 trillion. And just remember, part of this money is, of course, to increase the liquidity in the market. And to increase the liquidity is, of course, to tide over the current period where everybody is short of the money, the capital, and they just need to tide through this period. But part of this money is also injected into indirectly into the stock market. So you have the arguments for the positives, right? Just now we look at, you know, the optimism around vaccines, the optimism around some drugs. So every time you read about certain news, like recently about Moderna, a pharmaceutical company that has some positive development around the vaccines, suddenly you see the market goes up, right? So a lot of all those news will trigger market recovery. But let's also listen to some of the realities, like Dr. Fauci, who is a US medical expert, saying that there's no guarantee that the vaccine is going to be effective. And the antiviral drugs is not a total solution. And life will not be the same for now. And the economic recovery may also depend on the new normal that is executed. So in Singapore, you're already talking about the circuit breaker being released, and we are talking about phase 1, phase 2, phase 3. So it's still a long way from the actual recovery, from going back to the pre-COVID-19 days. And I really don't think so that as long as there's no vaccine that we will be able to go back to the pre-COVID-19 days. And of course, there's also the risk of second wave and further lockdown. We are already seeing that some countries, they open up and then there's some second wave and they have to go back to some lockdown measures again. And that's going to be very disruptive to the whole economy. And earlier on, I mentioned that QE is the one that is impacting the stock market right now, but they cannot be permanent QE. So let's take a look at this chart, which is really summarizing on the right-hand side, the optimism, right? So the bull argument, and then on the left-hand side, the bear argument. Let's take a look at it. So on the right-hand side, you have the Fed quantitative easing, which is definitely the key factor that is popping up the stock market pricing right now. And of course, you have the government's fiscal policies, again, temporarily kind of giving liquidity to everybody. Of course, there's also the optimism over the vaccines. And every now and then when you are going to be hearing news about vaccine development, every now and then when you're going to hear about antiviral drugs, this is all uh, going to prop up the stock market. Um, I have also been reading kind of a lot of people staying at home, and especially for new beginner investors, they are not too experienced in terms of when to go in, when to come out of the stock market, and there's this fear of missing out from buying some good companies at low prices, and they are just rushing into the stock market. Then, of course, there's the optimism that economies are already opening and we are going back to some kind of normal. So these are all the bull arguments, and whether this is going to last or not, let's take a look at the bear arguments. So there is a lot of optimism insofar as vaccine and drugs is concerned, but I've been talking to a lot of medical professionals. The reality is that probably in 12 months' time, probably in 18 months' time, there will be a vaccine, but that's still not a guarantee. So, frankly speaking, a vaccine solution may not be a very short-term solution. I think we will have to wait for the vaccine to be properly approved, properly tested, and properly developed, and then rolled out to everybody in the world. There's also, of course, the risk of the second waves, which we are already seeing, right? But looks like the second wave that we are seeing right now is still under control. But the economy is opening up, and then the second waves coming back are happening in those countries which have quite a good grip on the whole situation anyway. So I look at how US is opening up the economies and the precautionary measures that they are taking, no safe distancing, a lot of people are not wearing masks. I really don't know. I think we have to look at the next couple of weeks and then see what is actually happening when they open up the markets. Another thing to note is also the global economy was already weak even before this COVID-19 issue. And that is something to really take into consideration when we are investing into the market. Globally, there is very, very high debt, and we are talking about not just corporate debt, we are also talking about individual debts. And this can also give rise to another crisis if it is not properly managed. And of course, the other thing to note is that sectors are really very, very, very badly hurt. Sectors like the tourism, sectors like the airlines, sectors like the hotels, and they are not alone, right? There is some interconnected. The whole economy is interconnected, right? So if you're talking about airlines, I just read that Rolls-Royce is cutting about 9,000 employees retrenchment, and that is because Rolls-Royce manufacture the engines for the airlines, and if the airlines are not doing well, they are impacted, right? So if the hotels are not doing well, F&B is not doing well, so it will accordingly affect the other sectors as well. I think currently, if you are looking at the sectors which are doing well, it will be those that are a little bit more into technology, people working from home, they require the technology, like Zoom is actually doing well. But of course, I'm not suggesting that you invest into Zoom. I think let's understand a little bit about how to do the investment properly later on. And I do have some suggestions insofar as how you can invest during this turbulent time. So like I say, if you have any questions, you can just stop me right away, or we can reserve the questions until the end of the session, and then we can take the questions, I can answer them, and then probably as a community here, we can also do some discussions. I may not be right in all the issues that are being discussed here. So if you kind of read around articles and if you watch YouTube videos, you will probably see arguments from both sides of the aisle, right? And sometimes it's quite frustrating because some people are saying that, oh, it's totally a V-shaped recovery. let's really go back to the action. Let's go and buy some stocks, right? But I tend to want to take the advice of proven investors out there. And of course, the person on the right, probably most of us will recognize him as Warren Buffett. And he's about 88, 89 years old. And, his return has been averaging 20% per annum for the last, I don't know how many years, right? His entire life is actually into investment, right? So I think we have to give it to him. Of course, right now, some people are saying that he is no longer good at investing. His time has passed, and so on and so forth. Used to be that when he was not investing in the technology stocks during the dot-com bubble, the same thing happened, right? People were laughing at him. So let's see who shall have the last laugh. And the person on the left is also a very famous investor, Ray Dalio. And if you look at these two investors, Ray Dalio tends to be very blunt. He will share with you absolutely what he thinks about the market, and he's very, very, very bearish about the current market. Warren Buffett tends to be a little bit more conservative in terms of what he shares, what he's currently doing, right? So it is important to look at what he's actually doing rather than what he's actually saying. And of course, we know that he has exited all the airlines that he has bought into. He has also exited Goldman Sachs, which he bought into during the last financial crisis. Of course, he didn't give an explanation. But looking at what they are doing, I think we have to be a little bit cautious about our approach going into the market right now. So regardless of whether the market is going to have a V-shaped recovery or is going to go down, what we know is that if you keep every single part of your portfolio in cash, that means 100% in cash, you're not going to have any return, right? Or very negligible return. And the longer you are keeping your portfolio in 100% cash, the more you are going to lose effectively, because it's not probably even going to give you the return that is greater than inflation. So that is actually an opportunity loss. So regardless of arguments, whether is it going to be a V-shaped recovery or whether there's going to be a second dip, let's take a look at whether the market is expensive, by the way, right? So this is one indicator, which is the Buffett indicator, and the Buffett indicator effectively is a formula of the market, the total market capitalization of all the listed companies in US divided by the GDP, right? And of course, the calculation can be quite complicated, but if you look at currently what it is, it's about 133%. And if you look at the tabulation here, a ratio which is more than 115% is actually significantly overvalued. Right, so back to what we always know, right? We want to buy companies at value, at a good value, which means we want to buy companies when it is undervalued, right? So definitely, currently, if you are looking at the S&P, or rather the market as a whole, it is overvalued. So the question that we should be asking ourselves is this a time that we want to purchase into certain company? So the way I see it is that whether there's going to be a second dip and how long the recovery from the second dip is, whether we are going to be able to find a new normal, that means open up the economies again, right? And let all the economies go back to normal, supply chain come back to normal, or there is a medical solution. So I already told you that I've been talking to medical professionals that the medical solution, although there is a lot of optimism, although Donald Trump is touting that by the end of the year there's going to be a vaccine, I seriously think that this is probably not going to be a shorter term solution. So is it going to be 12 months? Is it going to be 18 months? We don't know. But all I can say is that this is probably going to be a longer term solution. Whether we are going to be able to open up the economies and going back to some normal, there is still an unknown. Hopefully, at least 50–60% of the economy can go back. Certain sectors again will remain in problem for a longer time. I think the airline industry is still trying to figure out a way to get passengers to go back to flying. Certainly, again, next 3 months is probably not going to happen unless it's essential travel. Is it going to happen over the next 6 months? I don't know, right? So we shall see. So now come back to the question. There are so many unknowns, right? And you have the bear argument, you have the bull arguments. So what should we do? How should we maneuver the market? And I have proposed some strategies for you. And of course, the first thing first is to stick to the fundamentals. So let's go to the key pillars of investing. And I like to repeat all these, right? Because this is really what works in the longer term, and especially if you are a longer term investor. So buy stocks as if buying businesses, right? And we will discuss what are good businesses later on, and buy only wonderful companies, buy at a discount, what we call the margin of safety, and buy companies which you understand, right? Right now, airlines industry, and I just read an article about SIA. As you know, the market is trying to kind of give it some financial support, and there is a rights issue and also some bond issue, and the rights issue price is actually at $3, but whether is it a good price to go in, whether SIA is going to be able to turn around and all that, we also don't know, right? But if you have some insights into certain industries and you are quite confident that they are going to be able to do well during this period, I think those are the ones that you want to be investing in. Buy companies run by sound management team. That is also another key pillar of investing. So this is a stock investment framework that I do, and we do, and we use to teach our students also. And it's what we call the 5-step stock investment framework. First of all, it starts with what are the kind of companies that you want to invest into. Just now I talked about only buy companies that you understand. So this is really talking about the circle of competence. If you know the financial industry very well, then just stick to the financial industry. If you know the technology sector very well, then just stick to the technology sector. I also tend to like to go for the bigger market capitalization companies. And of course, nothing wrong, but some people like to go for the small cap companies. I tend to go for the larger companies with a good track record. And then whether you want to invest into Singapore stocks, Hong Kong, US stocks. Right now, of course, you know that the Senate has passed a bill that want to really look at how the China companies are listed in the states, whether there are certain rules that they have to follow and so on and so forth. So potentially some of the China companies listed in US may be subject to delisting, but it's going to be a long process, right? The bill still has to pass to the House, and then it has to go to the president. But I think that is more of a geopolitical issue. Let's see how it goes, but there are certainly certain risks that you have to pay attention to if you are investing into some of the China stocks. Then the second step is a fundamental analysis, which we will go through in a little bit more detail, and then valuation. And then when we actually go into buying the stock, we want to apply a certain margin of safety. And of course, if you are a long-term investor and if you have bought into a good company, sometimes the best thing to do is not to exit from the company uh, too soon, right? You want to hold the stock, and as long as the company is still growing, you want to hold it for the longer term. Now, there's a particular option strategy which I use right now to kind of lower my risk and also to uh, supplement it with the fundamental analysis that I do and to buy stocks at the right price, which I will share with you and which is part of the strategy that I use during this time. So how do we select good companies? There is actually a metric, a list of metrics that we use, which we call the PhD fundamental analysis method. And we look at profitability, whether a good company is making good profits, right? So is Amazon a better company than Alibaba, right? Is Disney a good company than maybe some other companies and so on and so forth? We look at the profitability. The other thing which is particularly important during this time is the financial health. You want the company to be able to survive during this period if it has debts, and what is the debt level, and growth drivers, whether the company is continuing to grow its revenue and its earnings per share, its profits over time. And this is important because if you are investing into the stock market and you want to get you want to earn money from the stock market, you are either hoping to get returns in the form of dividends, or you are looking for the price appreciation. So as I said earlier on, the price move in tandem with the earnings. So if a company is growing its earnings in the longer run, then the share price of the company will also move in tandem with the earnings in the longer term. It will go up. Shorter term, there's always a fluctuation. That's how the market behaves. So for profitability, we have studied and we have applied this, and it's a good basis. Of course, certain industry, you have to adjust some of these numbers a little bit, but otherwise, this is a good basis for us to determine whether a good company is good uh, in this particular area of profitability. Net margin, we are looking at more than 15%. Return on asset is 7%, return on equity is 15%, and free cash flow, which is a very important measure, has to be more than 5%. So financial health, I won't go into too much detail, but we are also looking at three ratios, which are important. The debt to equity less than 0.5, the times interest earned, how many times the EBIT, right, is able to cover the interest expense is supposed to be more than 10, and the current ratio more than 1.5. And of course, growth, right? And there are a few sources of growth. I'll just use the example of Apple here. They have been going through more iPhone sales, raising iPhone prices, some of the other products that they sell, and they are also able to launch new goods and services such as the Apple Watch, which is selling like hotcakes. The AirPods is also selling like hotcakes. So I think that is quite a good success. So there's been some discussion around Apple to say that after Steve Jobs, the new CEO, has not been able to continue on product innovation. So that's one argument. But to me, actually, Tim Cook, he's a product person, he's a logistics, he's not a product person, he's really an operations person. But if you look at the entire company, you really can't say that Apple has stopped the innovation. I think some of these examples of the watch, the AirPods, has proven that it has continued the innovation track. And of course, lastly, a company can also grow by merger and acquisition. So if you are trying to look for a good company to invest in, right, you really want to look at company with growing trends of revenue and earnings. So let's take a look at Apple, right? So Apple revenue is growing very nicely, earnings per share is growing very nicely. I give you a negative example of some. So this is a Malaysia listed company, Pakson, right? So if in a longer term, the share price of a company will be in tandem with the earnings per share or the profits of a company, you can just guess whether what's the share price of Watson is going to be. I don't even need to look at the share price on the chart, right? I will know that it's probably going to be in this manner. Shorter term is going to fluctuate. That one nobody knows, right? But in the longer term, this is not a company that you want to invest in. So this is probably also quite a good company. Nestle is also quite a good company. This is also not one of those companies that you want to invest in. And really, those metrics that I shared with you earlier on, right, in so far as the profitability is concerned, in so far as the financial health is concerned, and whether the company is growing or not, uh, it's important in the sense that if a company is a good company, it's going to grow its value over time. So the line may be represented in this manner, right? So if Apple continues to grow its revenue and earnings, the value is going to go up, right? The retained earnings, the dividends is going to be able to give the shareholders is going to continue to go up. The price fluctuates, right? Sometimes it's above the value, sometimes it's below the value, right? And normally what we want to do is to be able to calculate the value of the company and then apply a margin of safety so that you are actually buying the company with a discount. But what this chart is, and I want to share with you, and that is to stick to good companies with those metrics that I just mentioned before, is that even if, let's say, you buy into a company at this point and you are effectively buying the company overvalued, uh, but if you are a long-term investor, it is actually okay. Let the share price fluctuate, right? But if the company is still growing its value over time, the share price is just going to reflect accordingly, and you are okay. If you are holding on to the company, and even if you make a mistake earlier on. Now, the reverse is true in the sense that if you are buying into a bad company and the value of the company declines over time, you are just going to have a problem, right? The share price is just going to go down. So this is a spreadsheet that we use, and I will switch over to the Excel spreadsheet to illustrate to you, and it's Apple, and I'll use that to illustrate a few ideas. So what I'm going to do is I'm going to share. Just give me a minute. I'm going to share the actual spreadsheet. Okay, can y'all give me a thumbs up if you can see the spreadsheet okay on your screen? Okay. So this is a spreadsheet that we use, that we also get our community to use. And a lot of what I've just said earlier on is actually all summarized here as a checklist for our community when they analyze certain stocks. And I want to use Apple as an example. I think most of us will agree that Apple is a good company, right? But earlier on, I also say that if it is a good company, you also want to do the valuation of the company. That means you want to roughly calculate how much is the intrinsic value or how much is this company worth, and whether it is the right time to buy the company or not. Right, so these are all things which I have gone through earlier on. Let me just go through it and share with you. So first of all is to ask yourself whether this is a company that you understand. And we do emphasize this circle of competence thing, whereby, you know, if you are amongst one of the players in the stock market trying to buy and sell Apple, right, you must have a certain advantage over them in terms of whether you understand the company better than them. So you can kind of predict a little bit better than other people in terms of the future of the company. So what we do in terms of our methodology over here is, of course, to look at the company, whether it has an economic mode. I mean, an economic mode is just another term for competitive advantage. And I would argue that, Apple has a good brand, and if you are an Apple user, you will know what I'm talking about. It is really very difficult to switch out of the Apple iOS ecosystem into, let's say, an Android. And because of that, the customers will kind of remain loyal to the company for quite some time. So the charts on the right-hand side, the revenue and earnings per share I showed you earlier on, is been growing. And what that means is that uh, if in the longer term, the share price should also move in tandem with the earnings per share. So if you bought into Apple in 2010, you should be making quite a fair bit of money right now, right? So what we do is we look at the historical performance of the company, and over the last 10 years or so, Apple has actually grown its revenue by 16.62%. And the profit, they have actually grown the company by about 30%. But more importantly, we also look at the profitability, right? And we look at the measures of the free cash flow, net margin, the return on equity, and the return on asset, and it has actually all done very well. Of course, we know that Apple has got a lot of net cash available to the company. I think the last that I remember, they have $100 billion of net cash. But if you look at the debt to equity and so on and so forth, we also have no concern about debt issues and so far as this company is concerned. Now then, let's take a look at the intrinsic value. And I will not explain in detail here how we actually do this calculation. But I will briefly explain to say that this is actually based on discounted cash flow of the company. And what we do is we look at the earnings of the company, the cash flow of the company. We make some assumptions about the next 10 years, and then another 10 years after the next 10 years, how, how much the company is going to be able to continue to grow at. So here we assume that the next 10 years, probably Apple will be able to grow at about 12%. And then after that, maybe it will slow down to maybe about 4%. And we will discount all those cash flows back into today's value. And we do the calculation, it's about $230. Now, do you all know how much is Apple today? Anybody knows how much is Apple today? Someone wants to give the answer over the chat group. Apple is about $320 today. Yeah? So I want to use this calculation to illustrate to you. If Apple is about $320 today, we calculated at the intrinsic value to be about $230. Now, so it is definitely overvalued. And in order to justify a intrinsic value of about 300 over dollars, what it actually means is that the company probably has to continue to grow at about, let's see, at about 17%. And if you're buying it at $320, you are actually going to be assuming that the company is going to be able to grow at 17%. But if you look at the growth of the profit or the earnings of the company, over the last few years, it's actually tapered off to about 13 and 6%. So I think you are really making an assumption that may not be realistic. And if you are buying it at this level and the next quarter, if Apple is going to announce some results, and maybe the next quarter and then another quarter, they are going to be announcing some results, which is not consistent with this percentage of growth, then you are actually going to see that the share price is going to start to come down because it is not performing to the expectation of the market. So this is a spreadsheet that we use, right, to try to see whether it is the right time to buy a company at a certain price. Besides knowing that this is really a very good company, it passed all the various metrics that we have actually put in place. Okay, so I will just stop sharing this Excel sheet and go back to the slides. Okay, so I will now go back to the slides. Okay, just give me a thumbs up if you are able to see the screen. All right. Okay, thank you. So if we are an investor, I think we need to have a long-term mindset to be able to try to win in this stock market. Unless, of course, if you are a trader, then it's a very different strategy altogether. If you don't have a long-term mindset, it is going to be very, very difficult because, as I explained earlier on, shorter term is very difficult to try to predict what is going to happen. Right? The market reacts to news, sometimes rationally, sometimes irrationally. So, but in the longer term, everything falls back to this rational notion that, hey, the share price has to reflect the earnings of the company. So one of the things that I advise people to do is that if you want to invest into the stock market, I think you should have a long-term mindset. So there's this other strategy. So one of the strategy that I share with you is that, let's stick to the fundamentals. Whether the market is going to have V-shaped recovery, whether the market is going to go down from here, let's just forget about all those arguments. I want to continue to be invested into the market, right? And I want to stick to the fundamentals. I want to pick wonderful companies with good fundamentals, and I want to calculate the intrinsic value of the company and buy it when it is undervalued with a good margin of safety. In fact, during this time, I will probably increase the margin of safety. Normally, in our community, we kind of give the guideline of 20% of margin of safety to our community. But during this time, I probably want to have a larger margin of safety, maybe 25%, maybe 30%. Now, from fundamental analysis, I can actually take out another Excel sheet and analyzing Alibaba. So I will not go back to an Excel sheet that I did for Alibaba, but let's say I want to buy Alibaba at $170. And Alibaba actually ended at about $200 as of last Friday, because again, because of the potential delisting, again, between China and US, they are talking about some friction again and so on and so forth. There is some jittery, and of course, China is passing a law regarding some security laws in Hong Kong. So there is some market jittery, and I think Alibaba share price has dropped down to about $200 again. But anyway, if I calculated that Alibaba, I want to buy it at $170, right? And currently is trading at about $200. I'll have to wait for the share price to drop. But there's also another strategy, which is an option strategy, and we call it a sell put strategy, which I use and we use to earn cash flows while we wait for Alibaba to drop. So how it works is this. There are two types of options. One is a call option, one is a put option. And let's just forget about call option for the moment. Let's concentrate on put option. Now, and I want to give you an example and an illustration through the concept of insurance, right? Let's say I own a car and I want, of course, to buy an insurance for the car. And the insurance company will sell me an insurance for the car. If anything happens to the car, they will pay me uh, some some compensation so to cover the damage to the car. But in order to get the protection, of course, I have to pay the insurance company a certain amount of money, which we call the premium. So going back to the Alibaba example, there is the options market, and the options market is in fact bigger than the stock market. But there's an options market whereby we are using a strategy which is called the sell put strategy to earn money while waiting for Alibaba share price to drop to $170. So in the meantime, I can still stay invested. So after doing all the fundamental analysis and all the calculations, let's say I am happy to buy Alibaba at $170 a share. Okay, currently it's trading at $203. So there's probably some people already owning Alibaba shares. And what I do is I want to be an insurance agent. I go to them and say, hey, if Alibaba shares drop to $170 and below, I will buy the shares from you. Okay, so this is called a sell put, right? A sell put. I promise to buy the stock if the share price drop to a certain level, which we call the strike price. Okay, and that's a strategy that I've been using to earn some premiums while waiting for the share price of the company to drop. So I share with you some examples of what I've been doing. So this is Alibaba. My transaction date was on the 24th of April. This will be like great to you at this moment, but basically what I'm doing is I promise to buy the share from someone if Alibaba share price drop to $170. And the expiry, just like when we buy an insurance, there's an expiry to the insurance policy. This also has an expiry. And for doing this, I collect $355. So actually what happens, by 17th of July, if Alibaba share price stays above $170, I would have kept the $355 in my pocket. If Alibaba share price drop below $170, then I'll just buy up Alibaba share price at $170, which is what I wanted to do. So this is actually a very powerful strategy, a strategy that we use options in conjunction with fundamental analysis. So of course, we can buy shares straight away. If Alibaba shares is already $170 today, and I calculated that it is undervalued, so I will just go ahead and buy it. But if not, I will use the sell put strategy to earn premium. So this is a sample of some of the options that I do from 16th of April to 8th of May. And some of these have probably changed. But from here, what I wanted to show you is that out of a capital of $60,000 US dollar, because options market only happens for the US market, I actually earn a premium of 1,200. So this is about 2 point something percent within 1 month or 2 months. And if you analyze it, this is a very good return of about 12 to 24%, depending on whether is it a 1 month period or 2 months period. So this is also a strategy in addition to the shares which I have gone ahead to buy. So this is another company that I've done, which is Berkshire Hathaway, which is a company that is run by Warren Buffett. I also bought the shares directly. I bought it average cost of $175. but I'm happy to buy more if it drops to $155 or $165. And if it doesn't drop below those levels, I just happily collect all these premiums. So this is also one of those things that I do in conjunction with just buying up the shares accordingly. So those are the two strategies that I'm sharing with you. One is, of course, to buy wonderful companies, but only undervalued. I don't really care whether the market is going to go up and down. If it is already overvalued, if it is already undervalued and it is a good company, I'll go ahead and buy. But one of the things that I do, especially during this time, is dollar cost averaging. So if Berkshire Hathaway, I'm happy to buy $175, but nobody knows, right? Maybe it will drop to $160. So what I do is, if I want to invest $30,000 into Berkshire Hathaway, I would have put $10,000 when it's at $175. If it drops to $160 per share, I will put in another 10,000. And if it drops further, I will buy again, right? But of course, your conviction must be there. You must be very confident of all the analysis and the homework that you have done. But this is also another slide that I want to share with you because it will happen, right? So it's really about managing emotions also. Some people actually say that it is hard to make money from the stock investment. But one of the biggest enemies that you have to fight against is yourself. And that is really talking about the emotions. So, if it is going up, everybody is very happy. People are having this FOMO, fear of missing out. They will buy. But if it is dropping, all these emotions will also come in. So, I think you have to learn to manage this aspect. To me, if I have already done the homework and if it continues to drop, and nobody knows where it's going to be the bottom. But if I'm a long-term investor, I've already done my homework. I ask myself the question of whether the company is going to be able to survive, it's going to be still around for the next 10 years, for the next 20 years, right? Then I will really just go ahead and average down and I will buy some more of the shares and hold it for the longer term. So take for example, Apple. One of the questions that we can ask is Apple going to be around for the next 10 years, for the next 20 years? I think probability of it still going to be around being a major company probably is quite high, right? And uh, if Apple today drops to about $220, which I have shown you the calculation, I will really buy. So it actually dropped recently all the way to about $240, $250, and I was kind of waiting, and I didn't manage to buy the shares. Yeah. But if there's going to be another dip, that is also one of the companies that I'll be watching very closely. So I also prepare over here some stocks that, especially for those of you who are kind of new and you want to kind of have an idea of where you can start looking at, right? Some of the local banks are definitely a good area to take a look. DBS in March actually dropped to about $17. I actually bought some. OCBC I actually also bought some at around $8, but they have recovered a little bit, right? And based on my own opinion and analysis, I kind of took profit. Those who are still holding it, there's nothing wrong, right? But my own analysis is there's probably going to be another dip, and I rather just took profit and convert to cash. But there are also some companies, for example, Capital Mall Trust, which I bought at about two. No, I can't remember. Which I bought at about 160 or something like that. Yeah, at about 160, which I'm holding. Although again, it went back up to about 190 or so. Is it 180 or is it $2 something? I can't remember. But anyway, some I have bought low and I have decided to just keep them for good. Um, Singtel is probably going to be releasing their result quite soon. It's again one of those that I had done some calculation and probably a bit more positive. And of course, some US companies with very good high net cash positions, but you have to be careful, right? For example, Apple, right now I do feel that it is too overvalued. But these are companies which are probably quite good for you to take a look because you know that they are definitely going to be able to survive this crisis. But Ford, I'm not too sure because it's in automobile industry and that is under tremendous pressure. Alibaba is again one of those with net cash position, and I'm still quite positive about the China economy in the long term. So it is also one of those that I'm quite interested to have, right? And of course, some speculative buys, especially if let's say you do see that some of these companies, if they are really very badly affected and the share price drop quite a fair bit. But as I say, this is speculative, so you don't really want to have a large portion of your portfolio into these companies because if you analyze these companies, they are probably not going to be able to pass some of those metrics that I have shared earlier on. So I talked about building a portfolio, and this is again a suggestion of about 10 stocks that you can start building a portfolio if you are just starting out, right? And I, I, I personally actually built my portfolio around this, but um, and you don't really need to have a lot of counters within your portfolio. 10, is a good number. For me, I have a lot more than this. I have about 20, but that is because I have a little bit more time and I want to diversify out a little bit more. But this is a subset of my portfolio that I'm building. Some I have taken profit, but some I really own it into my portfolio. So I won't go into the detailed analysis, but Berkshire is a good one. Facebook, Google, DBS, and then Alibaba, Disney, Microsoft. This is a country index, which is a basket of the top companies listed in I think Hong Kong, but top companies in China and top China internet companies. So you have the Tencent and so on and so forth. Now I like this particular real estate investment trust, Capital Retail China Trust, and the price has actually dropped quite a fair bit. I actually bought some at 130 and some at $1. Um, and if economy in China is kind of opening up, and if they are not going to have too much of a problem opening up, then I think it will probably recover quite fast. And anyway, I like to have some dividend paying stocks in my portfolio. But what is also very important is this part which I kind of highlighted. Uh, this is already fully vested, right? But at any point in time, especially during now, earlier on I say I will divided my investment into a particular company into various batches, right? So Berkshire Hathaway at $175. If it drops to $160, I will add. If it drops to $140, I will add. Right? I won't buy it at $175 one shot, right? So for those of you who are keen to get an analysis of actually 20 companies that, not really a full analysis, but some write-up of a list of 20 companies that I've done, you can also try to contact me, right? But building a portfolio is important because, you may make one or two mistakes. And what we are trying to do is, of course, to minimize all the mistakes by having a good fundamental analysis and a good grounding in terms of our understanding of the companies. Okay. So coming to the last slide, right, which is really a summary. I think the US market is expensive now. Now, the Singapore market is not that expensive, but the Singapore market tends to follow the US market fairly closely. So even though it is not that expensive, you also don't want to buy it at the wrong time. If US market drops 20%, it's likely that you Singapore market you are going to see some drop as well, right? So we usually try to take a look at the US and benchmark against the US because that market is much bigger than the Singapore market. In fact, the options market is only available for US and not available for Singapore. Right? So although the US market is expensive now, there are some individual stocks which are undervalued, which you don't really have to wait, right? You can go ahead and invest in them. Although I would say that there are not too many of them which are undervalued right now. Of course, I'm not talking about those which are beaten down very badly because they can't operate, right? So the likes of the airlines and so on and so forth, the value of the company from the high has been hammered down by about 40-50%. Cruise lines even worse, right? Yeah. So Carnival Cruise, I think the share price has dropped a lot. That is also one of those speculative ones, and I'm using options to make a play right now. So of course, just now I share with you that option strategy is also one of those whereby if you think that the price is high, but you want to wait and you want to still earn some premiums of it, you can use the sell put strategy to earn premiums along the way. So stick to fundamentals, have a wide margin of safety, stay invested but do dollar cost averaging, and always have some spare cash because we don't know whether it is going to have another 30-40% drop again. My own opinion, okay, is there will be a second dip. When it's going to happen, I don't know. But my own opinion is also that because of the massive quantitative easing and low interest rate and so on and so forth, you are not going to probably see a drop that is very drastic. So if you start to see 20%, 30% drop, I think you can start really going into, again, using the fundamentals and using the valuation technique, right? You want to start to go in and buy up some of the good stocks and hold it for the long term. Likelihood of 40-50%, it may happen, but I think it's not so likely. That's my own personal opinion, right? Insofar as the current situation is concerned, right? In particular, I am really going to monitor the next quarter's earnings release by companies because that is when the impact, the full impact of the lockdowns and so on is going to be seen, right? So I think already a lot of the companies, usually the US companies, they give you some kind of guidance of the whole year performance, but a lot of the companies are already forgiving the guidance going forward because they just don't know how to predict. In fact, China doesn't even have a GDP guidance this year because they are saying that there is so much unknowns. And bear in mind, China is the first to come out from these infections, right? And although the issue, the crisis is not over yet, but so far they have put it under quite a bit of control, and they are recovering from the economy the earliest. Like the rest of the countries are still struggling, right? So if China is even having a problem, I think the rest of the countries will have a lot more problem. So again, personally, I think the worst is yet to come. And even if, let's say, it is not that bad, but recovery is going to be taking a very, very long time, a very, very long time. And we are going to hear a lot more um, companies saying that they are in trouble, they are filing for bankruptcy, right? And lastly, I think if we are having a stock investment with a long-term mindset, we can be assured that if we are buying into good companies, the return will still be good, right? So that's the last slide that I have. I want to open to questions, and okay, there are some questions also. And there is one question on the chat group, which you can also do if you are shy, but otherwise you can unmute the mic and then, pose a question to ask. Do you think Facebook is too overvalued as well? I think so. But again, you don't have to listen to me. You can just use the methodology that we have, which is a valuation methodology. I was actually doing Facebook at about 150, 160, 170. Recently, Facebook has gone up to 230. But Facebook at 230 is not as expensive as Apple at $320. Yeah, and I think that Facebook still has got a lot of tremendous growth opportunities going forward, purely because it has got billions of users right, on its platform. And there are a few developments around Facebook that I'm particularly very excited about. If they are able to go ahead with Libra, I think that is again going to be a huge game changer. Yeah. So Facebook is 220, 230. I'm not the most comfortable, but you know, um, if it drops to about 180, 190, I think that is a level that I'm quite comfortable. So there's another question, am I still holding Baba shares? I kind of took profit. So I'm not holding Baba shares right now, but I have sell put position. So I'm earning the premium. And I am So if it is 1 month, I don't think the whole saga around delisting is going to be happening. So I'm a bit comfortable in terms of holding it. Yeah. So there's a question about the value of Facebook. The last that I calculated, 180, 190 is a comfortable intrinsic value of Facebook that I have. So actually, remember in December or towards the end of 2018, there was also a market decline of about 20 over percent. That is the time when I made quite a fair bit of money, and I mentioned that you don't really need to have a lot of counters in a portfolio. And for those of you who know me, right, after a while you will find that I'm quite an uninteresting person because my portfolio will go around a few companies, uh, the likes of the Apple, Alibaba, Facebook, Google. Recently I am quite interested in Microsoft. So these few companies. So when Facebook actually dropped to about $120, $130, I was drooling because at 120, $130, it was such a bargain. Yeah. So I actually bought quite a fair bit into Facebook during that time. Yeah. Any questions that I can take? Again, you can either put it onto the chat group or you can just unmute and then you can ask the questions directly.
Hi.
Yep.
Okay, I have a question about selling put options.
Yep.
How do you decide whether it is worth a while looking at the premium other than, like, I think it was 2.5% or 2.9%, the calm investing guideline, the return?
I know there was some guideline given, and the guideline is to kind of prevent people from just chasing after the premiums, right? So, if you look at the sell put strategy, and given the current market, which is very volatile, sometimes you can actually get very good premiums, 3%, 4%, depending on the strike price that you choose. So there was a guideline that is given, which is about 2.5%. But I'm not so hung up about that guideline, so long as it's not about 0.5% and so on, right? If it's giving me 1%, annualized 12%, ask yourself the questions like, what gives you annualized 12%? Can you get any other investment which is at 12% annualized, right? And if it makes sense to me, then I will just go ahead and do. So it is really about that particular moment in time. If it gives me 12% annualized return and nothing else, there's no other investment that is more than 12%, I'll go ahead and do it. Okay.
Okay,
Yeah,
thanks.
but don't do it for annualized 2%. No point, right? I think there should be other investments which are better than annualized 2%. Right? Yeah. So to me, if I see 1% and there is nothing else that I can find, then I'll just go ahead and do it. Yeah. But during this period, actually, most of the premiums return is actually quite good.
Did you say good or not good? Sorry, didn't hear you.
Quite good, yeah.
Ah,
Because
it's
the
volatile.
because the premium is also a function of market volatility. So during this
Mhm.
time, the market is very volatile, and so the premiums are also generally quite good.
Mhm. Okay, thanks.
Any other questions? Again, you can just post the questions directly, or you can put it on the chat board on the side. Okay, I have one other question. Is the exchange risk around USD something to be concerned over? Yes. Yes. Uh, and that's the reason why my portfolio is not entirely US. Okay. And what I do is I tend to exchange uh, my money and transfer over to the account in the States whenever the exchange rate is in our favor, right? I know the US currency right now is a little bit on the high side. And again, that is going back to what we discussed earlier on regarding quantitative easing. The reason why I say quantitative easing cannot happen too much and forever is because if US continue to do this, right, there may come a time when US may not be the currency of choice or exchange globally, right? Because it's just becoming a becoming a joke that the company can just print money, right? Print money to a certain extent, quantitative easing, uh, and inflation doesn't happen in US, but inflation happens in other countries. So it's actually quite interesting, if you think about it. Now there is a lot of money in the market, right? Because of quantitative easing, and the stock market is also a supply demand issue. So the reason why the stock market has gone up so much is also because with so much money in the market, right? So where do you put your market, right? Gold, right? A lot of people don't really believe that, gold is the way to go. And then bond treasury is not the way to go as well. So where else can you find return, right? And for fund managers, for banks, when they have so much money, right? The only place that they have to go to is actually the stock market. But yeah, be careful about this US thing, the USD thing. Um, I won't suggest that you have 100% of your portfolio there. But again, if you have a long-term horizon, right, um, the currency is also a short-term fluctuation. At this present moment in time, I still don't see too much risk happening around the USD in the longer term, right? But because of the potential exchange rate risk, you may not want to have 100% of your portfolio in the US market. Right? Any other questions? Any other questions? No? Uh, so if you don't have any other questions, I know some of the people on this webinar is already in my community. So you can actually drop off the call from here. For the rest of the people here, actually we as a community we do offer a course which we call the cash flow mastery program. And if you are keen, for the rest, you can actually drop off the call. But for those who are keen to find out a little bit more about the cash flow mastery program, which is a 2-day course, I will be able to share with you the course that we offer and also a special offer that we are going to be able to provide you. So let's see the interest. So for the rest of you, I have actually finished my presentation and I'll be going ahead to share with the rest of the participants here regarding the course that we offer. Okay, so I will go ahead and